to our market panel. Joining us now is Invesco Global Market Strategist Brian Levitt and CNBC Senior Markets Commentator Mike Santoli, who is just on TV all day, grinding the gears here. Brian, mixed end to the month of August here today, with the S&P finishing down slightly lower, the Dow lower, but the NASDAQ eking out some gains. We're still lower on the month. The rally we've seen in recent days, can it continue from here?
Yeah, I believe it can. I mean, this is a market that early in the month was very concerned about higher interest rates, growth being too strong, and perhaps inflation not coming down fast enough. And so we've seen that unwind over the last few weeks, which has been healthier. You've seen the economy continue to show signs of moderation, and you have signs that inflation is moving towards the Fed's comfort zone. And so as that's happened, interest rates have come down, which has provided support to equity valuations. And so I think it persists. Now, you might see a little bit of a shift in leadership. It's been the tech-heavy, growthy names here. But as the market starts to get more enthused about a soft landing, you would expect to see some broadening out of that.
Yeah. Mike, I mean, a rate reprieve, that has been sort of the theme of these recent days of trading. And certainly that's given renewed life to some of those tech names, communication services, consumer discretionary as well, which have been some of the best performers over the past week. To that point, do you need to, or can you see a rebroadening out of some of these other sectors that did end the month in the red?
Yeah, you certainly could. I do think that was part of the story going into the July peak in the market, was that it actually had been much broader, especially this month. Things like energy, also healthcare perking up as well. So you're seeing some signs that it's not just a very narrow slice of the market performing. Now, the reset in yields lower obviously has taken a lot of the pressure off of equities. And you also had oil prices run up to the kind of the top end of the range and come back. So it sort of tested the market on all those fronts. And then sort of the market buckled a little bit. We had a shakeout. There's a way to tell the story that that's all it was. Sentiment got a little too excited. Now it's been moderated a little bit for the moment. And maybe that's all we needed. So that's the completely best case benign scenario going ahead from here. But it is subject to the data still looking like a relatively soft landing, and things like yields, commodity prices, the dollar not really racing and breaking out.
Brian, there are a number of companies reporting this afternoon that you really want to see growing if you believe in small and mid-cap innovators. MongoDB, for example, is the top percentage holding in the WCLD, which I think closed up better than 1.5% today, when the major averages weren't doing that hot. If you want to believe that this AI story continues to have momentum and legs beyond NVIDIA as well, MongoDB had a story to tell there on their sort of database insurgency with Atlas versus Oracle. What are you particularly watching on that storyline?
Well, what I'm watching in terms of small and mid-cap businesses is, how does the market feel about the future state of the economy? And what we've been seeing was, if you looked at March, April, May, it was a market that was very concentrated and was concerned that some of the banks were challenged and that higher rates were forthcoming and going to slow this economy down meaningfully. It's a different feel now. It's a market where we've seen spreads come in. You've seen smaller cap names do well July and August. And so it's a market that's telling us that growth's actually going to be quite good between now and the end of the year. And so we've opened up this environment again, as we saw in middle of October last year. We've opened up an environment for risk assets to do well. It's a market that we believe will become increasingly enthused as the year progresses about the resiliency of the U.S. economy. And that type of resiliency, albeit, weaker than it once was, but that type of resiliency does favor more small and mid-cap businesses more than it did certainly in the early spring.
Mike, and with the 10-year yield under 4.1%, not saying that there's a direct relationship here, but it does perhaps give a little breathing room for people to believe in those small and mid caps.
For sure. Small and mid caps, I mean, I would say housing related. So one thing that's been encouraging over the course of August as things got very choppy was that cyclical sectors did not really buckle relative to defensive ones. It really wasn't a rush for safety. That indicated things like industrials hanging in there. That often correlates with smaller stocks maybe being able to hold up as well. So all that more or less came together, and consensus earnings estimates continue to nudge higher through this earnings reporting season. So you have that support underneath, even if things get a little bit dicey on the valuation side or if rates cause a little bit more of a gut check.